Good, good. It's good to see you. How's everybody on your end of the camera?
It's good so far. Staying safe, staying healthy. How about you guys?
Okay, yeah, we're good. Staying home, following the confinement orders and directions, and hoping that this will uh, be under control soon. Hopefully,
Yeah, fingers
um,
crossed.
yeah. So just wanted to have a little chat with you to kind of like keep our clients and friends and informed about what's going on in the market, in the real estate market, in the lending market. So I think you were telling me a couple of weeks ago, 2, 3 weeks ago. Of course, we knew the rates had gone down drastically. The Federal Reserve had lowered the rates by a lot.
Mhm.
But then I think you said it actually triggered a huge influx of people wanting to refi, and the banks had a hard time handling the flow, and so they artificially raised the rents, the rates, right? You want to tell us a little bit about what's going on with that?
Yeah, so what we saw about 3 to 4 weeks ago was the interest rates dropped a lot related to the coronavirus. So we were seeing the global impact of the virus, which caused our market to drop its rates. So in that drop, we saw such a surge of volume of refinances. Basically, anyone who's done a loan from about 2015 or 2016 up until recently was in a position to refi, which is a huge market of people to look to refi. So what you had is in a very short period of time, a massive surge of rate lock, and the banks were
Right.
not prepared staffing wise to handle this. As an industry, we were projected to do about $1.5 to $2 trillion in 2020 between purchase money and refinance money. This is now ballooned to over 5 trillion by their
Oh
estimation.
my God.
So, from a staffing perspective, banks were not prepared. So, what's the one way that a bank can control volume? They raise rates artificially because they can. They can do whatever they want. So,
Right.
this is one of the first times you've seen a correlation where the 10-year Treasury being at 0.3%, where you would think the rates should be in the twos, maybe even the ones, and the banks aren't doing that because they can't handle the volume. They
Right.
also want to make sure they're controlling service levels. And another thing that consumers don't realize is there's something called an early payoff penalty. This is not something that has anything to do with the consumer, but it has to do with bank to bank. So if loans are getting paid off too quickly from one bank to another bank, they're penalizing each other for early payoffs. And now all of a sudden, if you extrapolate that number between how many refis are going on in a short period of time, the banking system can go belly up because they're penalizing each other hundreds
Right.
of millions of dollars. And now all of a sudden, the banks are being put out of business based on sheer penalties. And this is something that is standard to the industry. It has no effect on the consumer, but it's something that affects the secondary market for how loans are done.
Right. So basically, they're raising the rates to kind of slow down the flow. It's like shutting the closing the faucet, basically, so that people aren't as interested in refinancing at this time. I assume there's also probably a liquidity issue of how much cash banks have access to.
That's correct. So the liquidity is a huge part of the issue. So as we saw the virus concerns growing, the liquidity available in our market shrank dramatically. And so what that means is you're seeing banks that do A paper loans, all the stuff that's Fannie Mae, Freddie Mac backed, and even portfolio banks, banks like Union Bank, Luther Burbank, these are portfolio banks. These banks are able to still sell their loans because they follow a different pathway of liquidity. And what you're seeing is banks that mirror stuff like subprime, which we call those non-QM loans, the bank
Right.
statement loans, the cash flow loans. There's no liquidity for them now. So all of these banks they're not so much shutting their doors, going out of business, but they're shutting off their warehouse lines, not taking anything else for the time being because there's no market for them. They don't have a
Right.
place to sell. So it's definitely changing the market for a little bit and focusing more on driving the A paper loans through Fannie and Freddie to help, stimulate the economy, keep the housing market going, and keep the banking industry from failing.
Right. Okay, that makes sense. Thanks for clarifying that. So, a couple of weeks ago, I remember you and I spoke, and you told me that after the rates were very very low, below 3.5%, even 3.4, 3.39, the banks had raised the rates to slow down the flow, like we just mentioned. And you said, well, it's probably going to last a couple of weeks until they absorb all that excess, and then maybe they'll start, reloading the rates again to take in more business. But now we still have that liquidity issue. So my next question is there still a liquidity issue? And it sounds like there is. And if there is, then are they lowering the rates? Are they back down? Where are the rates now? Or are they still keeping them up maybe around the 4% to still keep people, I guess, away from refinancing or taking on new loans because they don't have enough cash available?
Yeah, that's a great question. So the other day, the Fed made that special announcement on the Sunday afternoon that they were lowering the target rate from basically to 0 to about 0.25%. So what that's doing is driving the liquidity into the housing market. It's creating more liquidity. So they're not going to let the banking industry fail. When they inject that kind of liquidity, it provides some more stability from the bank's perspective, and they feel more comfortable to lower the rates. Now,
Right.
we're starting today. I'm seeing pricing improvements where some of the rates are coming back down to where they had been initially before they spiked, and they're probably going to drop a little bit further. So we just have to give a little bit of time. And all the banks seem to go on the same pathway. When one starts to make the adjustments, they all start to follow. So I would say that that's still a likelihood that in the next week or two, you will start to see a consistent drop in the rates again across the board due to more liquidity. And also because the banks that funded all those loans on the refis, they're going to need to fill their pipeline again. They're going to need to hit margins in their quotas.
Of course.
So how do you do it? You lower the rates again and get that next wave of group, the next wave of people that missed out the first time. And trust me, people have been working diligently to put their paperwork together, whether it's with me or other lenders. And we're just watching very closely for that next striking point, and then they'll take advantage of it. So it's not going away.
Right. So as of today, March 23rd, 2020, on average, what are the rates on a 30-year loan?
Yeah. I priced one earlier this afternoon with strong credit, good equity on a condo, and it was around 3.375, which is the lowest I have seen in about 2 weeks. And to put that in perspective, the same bank that I had priced that with, I did it on Friday, same scenario, and it was 5 1/8. 5 1/8.
Oh my God! Wow, so it's a huge drop.
Volatility of one day to the next, going from a Friday to a Monday. As a lender, I'm like rubbing my eyes, closing out, repricing, and do something incorrectly, because they're one of the first banks to now take that and roll with it and take that liquidity boost and lower their rates. And I'm sure more will follow.
And so somebody who had been, is somebody able today to lock this rate? Are the banks still letting you lock rates for like a 30-day period so that in case they raise it again, you're still guaranteed to have that rate?
So in general, most banks right now are not doing 30-day locks. They're pushing the lock volume out to about 45 to 55 days, which as a lender, I'm going to recommend that anyways, because the amount of paperwork involved on our end, staffing and compliance and underwriting turn times, it's just taking us that long to get through the pipeline of everything. So to lock a loan for that short a time, it's going to cost more money to everybody involved. So for the most part, the banks have shut off that 30-day. But what a lot of them are doing, and I can't speak for every bank, but a lot of them, what they're doing is taking a 55-day lock, but applying 45-day pricing to it so that they can try to make it a little bit more attractive and not have to worry about the cost so much on a 55-day lock. Now, that's not every bank, but I've seen that in some of them, and it makes sense because they're trying to deliver better pricing with an understanding of we don't have control over the fact that we can't deliver loans in less than probably 40 days.
Right. Great. And so today, somebody who wants to get a refi, what is the length of approval for that? And same question for a purchase, on average.
So purchase money has not changed. Just because we're in this lending environment where it's a little volatile and we're seeing some changes across the board with what CAR is telling everybody, all the realtors, what they can and can't do, we're still seeing that you could do an average purchase in like 30 days. I probably wouldn't push it any less than 30 just because we're dealing with changes every day related to inspector access, appraiser access.
Yes.
Sometimes if you need an appraisal, how quickly can it get done? Turn times are changing on a daily basis, but in general, purchase money will be okay. 30 days should be fine. On the refi end, I would really say expect to take 45 to 55 days just to give yourself some breathing room to know that it can get done with all the different departments that have to get done. And a big part of why it's taking that long are payoff demands. When we're doing a refi, we got to contact the existing bank and get a payoff statement to know exactly how much they owe. And think about how many millions of people are doing this, how many payoff demands they're trying to process. So it takes time to get that document from the bank to know if we need to make adjustments to the loan amount, whether higher or lower. So just all of those reason being, expect 45 to 55 on a refi.
Right. Just to clarify for our viewers, the payoff demand is basically since you're refinancing, you have an existing loan with another bank. The new bank, if it is a new bank who is giving you a new loan, has to contact your current bank and ask them, hey, how much do we actually owe you? They need to have that official answer from that lender in order to pay off that loan and give out that new loan. And so it's that payoff answer that's taking a long time right now.
That is correct. Yes.
Right. My next question, I'm looking at my little notes here. So people who were approved, a little while back, maybe, a month ago, 2 months ago, do they need to get reapproved today? Is that your dog barking in the back?
Sorry about that. Working from home makes things quite a challenge sometimes when you've got the dog
here, so we're all good. she was just enjoying the sunshine, so it's all good.
Yeah, sorry about that. Sorry, you were saying?
So I was saying, if you've been pre-approved, a month ago, a month and a half, 2 months ago, obviously you would probably need and want to get pre-approved today, at least to go over your rates. But also, there's going to be an issue, and that's the second part of that question is, what are the banks doing right now? Obviously, the ability to get a loan from a lender is your ability to repay that loan. So I'm sure there's a big question about job security and, will the bank, are the banks going to be able to give out loans given the current situation?
Yes. So we're still getting a lot of updates to this, Michel. But in a nutshell, depending on the loan that your client was qualified for, you should double check with the lender. For example, if they got qualified on a bank statement loan or an investor cash flow loan or some sort of expanded criteria loan, which is what we call those non-QM loans, it's a market
for our viewers what QM non-QM means, just for our viewers.
QM, yeah. So QM stands for qualified mortgage. It's a term that we use in the lending industry to basically support a loan that's saleable through Fannie Mae or Freddie Mac. It's backed by, it's repped and warranted essentially that the banks can sell this back and forth to each other. There's safe harbor rules that are involved that are basically protecting the mortgage, that the ability for the person to repay is a little stronger. Okay.
Right.
So these other loans, these non-QM loans, are non-qualified mortgages by definition because they have some sort of expanded criteria to it that's different than what Fannie and Freddie do all day long. So, for example, someone doing a bank statement loan where they're showing their bank statements only and they're not showing W-2s, pay stubs, tax returns, where, on paper it looks like
a lot of people in LA are self-employed, whether they're in the entertainment industry or garment industry, realtors. A lot of people are not on salary; they are self-employed. We write off a lot of expenses, and so there is a special type of loan out there, which is a bank statement loan, where the bank will look at your influx and outflow of cash and make an assessment based on that, rather than strictly on your income tax return.
That's correct. So this market is picking up a little bit right now because there's that liquidity issue, and everything is really going towards paper loans with Fannie and Freddie right now. So anyone who's been qualified for that kind of expanded financing should be reassessing their qualification right now with their lender and their realtor, first off. anyone else that got qualified a few months ago should just be re-upping their qualification to see where the current rates are, because of such a volatile spike where we saw rates go from the low threes, high twos, to now all of a sudden the high fours and fives. That's a very wild swing. So you want to make sure that you're getting a hold of your lender to requalify it and know what kind of buffer they may have given on the interest rates. I don't know how many lenders sit there and buffer over a 1% difference in interest rates, so you want to make sure you're qualifying something like that. I'd say a good rule of thumb, at least on my end, is I usually give about 1/4% to maybe 3/8% wiggle room in case the rates move up. But I can't imagine someone anticipating a swing of over a 1% when qualifying someone. So if they were border, that can be a game changer to what they can afford. But in a market where the rates will probably come down, they should definitely just reassess, because they may be able to afford more than they could before because of the drop in interest rates.
Okay, great. And so last question, which was the second half of my question, is how are the bank looking at the current situation in terms of security of employment, future ability to repay their loans? You're employed today, and unfortunately, with the coronavirus situation worldwide, you don't know if you're going to be employed tomorrow. Up until now, they were looking at your income tax return to look at your history, and they were, I think, asking for a verification of employment just before they would give out the loan. Is it still the same thing, or are they going to require some sort of, letter from your employer that they're going to be around for the next, few months, few years, or is it still business as usual? I don't think it's business as usual, but what's the new situation?
So we're actually just getting guidance on this today with Fannie and Freddie of how they're treating it. Now, again, every bank's going to be different, but they've given us some updated guidelines of how to treat people's employment with doing VOEs, which is a verification of employment, of basically verifying they still have a job, that they're on the job. So we're getting new guidance on that. They're looking at documenting their consistent pay through bank statements. They're also making adjustments to just showing maybe the last pay stub. So honestly, that update came today. We don't have guidance on how all the banks are going to play that out. Some of them could have overlays that they still kick in on top of that. But Fannie and Freddie just came out with that today with their guidance with regards to income and stability. I would say that in general, Michel, anybody that's in the self-employed spot where their business is temporarily halted completely, they could potentially have problems here. People like the entertainment industry, people like restaurant owners, where they may not be open doing delivery or pickup of any kind. There is very crystal clear guidance that says if you are affected by the pandemic and you're self-employed and there's no income coming in, all the income that you're showing is invalidated.
Right.
It's basically a zero qualification.
Wow.
So we'll have to see
That's
how
huge.
that plays out. Certainly, I deal with a lot of people in the entertainment industry who are on hiatus now because of this. So we'll have to see how they consider that in terms of, is that considered variable income that's more stable, or is it completely unstable? So we'll just have to see as time goes on.
And that's the same for refis, right? As well as, not just for purchases, for refis as well, right?
Yeah.
This is a huge piece of information.
It's just a matter of how do you look at somebody's income, plain and simple.
Yeah.
And so it's not going to differentiate it. It's like, how are they making money? And that's the underwriter's job, is to be a little more conservative right now.
Yeah. Great. Well, Michael, this has been really, really helpful and informative as always. I really appreciate it. I never even had a chance to introduce you at the beginning of the video. You're Michael Abram. You're with RPM Mortgage, one of the largest, if not the largest, private mortgage company in California. Is that right? Am I saying this right or no?
The largest, but we're very big. We have a lot of branches between Northern and Southern California. Yeah. We also are branched out in different states. We own a couple different boutique companies on the East Coast. Right. So by that definition, our size is pretty large. We have access to a lot of different banks because of the size of our company, the size of our portfolio of what we service and sell. So it's given us a lot of options for banking and broker. Makes us very competitive.
Great. Okay, well, I'm going to make sure that your information is on the video, which I'll be editing just a little bit, and I'll put that online, so we'll have that at the bottom of the screen. Again, thanks for checking in. All the best to you and your family and your cute kids. I keep seeing the photos online on Facebook. They're great. Really appreciate that you took the time to talk to us right now, because I know you're busy with refis. So thanks a lot. Stay healthy. And stay confined, stay at home, don't go hang out on the beach. And I know you don't, I know you won't. We'll check in again in a few days and see where we're at.
Sounds good, Michel. Thank you. I appreciate the time.
Okay. Yeah, same here. Thank you. Take care. Bye-bye.
Take care. Bye.